Welcome. My name is Trent Malachik, and I'm an Area Ag Econ Specialist with the Oklahoma Cooperative Extension Service, and I'd like to welcome you to our presentation titled Utilizing Crop Insurance for the Average Producer. This presentation is going to walk through some of the steps that producers, especially here in Oklahoma, go through to determine if they are interested in purchasing crop insurance and how they can do that, and some of the common questions that I get as a Ag Econ Specialist on this topic. So the first thing I would like to focus on in this presentation is finding a crop insurance agent. Now this is obviously the most important step, as I put it there on the slide, because a good crop insurance agent can help you navigate the crop insurance decision. It's very complex, and this presentation is not meant to focus on every single piece of the puzzle, just to hit the highlights and get to your ideas rolling about the types of things you will ask your agent. And that hyperlink there on the slide will send you to a web address that can help you find your agent in your local area. You can put in your local zip code or your address, and you'll be able to find a list of crop insurance agents there. Another good way is also to talk to fellow farmers and neighbors and determine individuals that they use and trust on a daily basis. So again, there's several ways you can go about doing that, but that web address there, if you don't have any neighbors or you don't have any current contacts, can get you into a crop insurance agent's office and get the process rolling. So after we get finding a crop insurance agent out of the way, we'll begin with, what is your experience? As a producer walks into my office that has never purchased crop insurance before, I'll start off with a few questions, and of course that first one, have you utilized crop insurance before? If that answer is no, then we have a long process to talk about how it works and how it can be used for an operation. First off, I can also ask if they have heard about crop insurance before or they've been a part of it. Have they ever taken an active role in product selection? Because crop insurance today is not the same as it was in the past, and if they have purchased crop insurance several years ago and have taken a break and are now wanting to purchase a safety net program again, then they're definitely going to see some different products being offered that may not make sense to them. So it's worth definitely going through the process of determining what types of extra products can help their crop insurance guarantees and help lower their price as well. So, and I also ask if you're familiar with the current government safety net programs, because more and more crop insurance and government programs work hand in hand as part of the farm safety net. So it is a very important question to ask. It's, as under the current Farm Bill, we have ARC and PLC. We also have the SCO program and STAX and various different other programs that are available to producers. So you have to get a whole picture when we're thinking about the safety net program. What other products are out there and how much guarantee do we need from our crop insurance to help bolster our bottom line and ensure that we can stay in business from year to year. Our next topic comes to identifying your risk exposure. Now, just like when you purchase insurance for your car or your home, the more coverage you receive, the more cost is going to be associated with that. So I ask producers to identify what type of producer they are, whether they have just grain crops such as milo or wheat, corn, soybeans, or do they also have cattle that they use as another part of their operation, because we look at the farm as a whole and the total farm revenue, and we think about, how much revenue or yield do we need to guarantee in any given year to ensure that we can continue to operate in case disaster strikes. And I also ask how many farms have base acres enrolled in either ARC or PLC. Now, agricultural risk coverage and price loss coverage are two programs in the 2014 Farm Bill that producers were able to sign up for, and they act differently. ARC's more of a revenue product, and PLC is more of as it implies, price loss coverage. So as prices go down, that product becomes more useful. So if a producer is enrolled in, say, ARC, I know that they have a shallow loss revenue product that is going to help in small shortfalls, but isn't necessarily going to protect them from very large price decreases like PLC can. So the decision has to take into account the safety net programs as well. And then what about your risk exposure? Do you have a high debt to equity ratio? Are you a new producer who is just getting started that has quite a bit of debt? Because if you are in that situation, you may need a higher level of coverage than, say, an established producer with good liquidity and can weather some of those potential storms using their own liquidity positions instead of relying so much on crop insurance. So oftentimes we do see producers wanting to cover most of that risk with crop insurance, but there are some that opt for lower levels to reduce costs. And then invariably we have to ask, what is the variable cost of production on your operation? Or you could also look at the total cost, but sometimes it's easier for producers to determine that variable cost. On any given year, what does it cost them to produce an acre of wheat or an acre of grain sorghum? And if they can answer that question, we can start to drill down on exactly how much coverage they need based on their approved yields and the insurance prices being offered. So determining your coverage requirement. This decision varies from producer to producer, and there's no single answer for anybody. And that's why, again, we go back to that first slide where we talked about finding your crop insurance agent, is that crop insurance agent can help you answer this as well. But when I try to help producers with this question, I find that it's highly dependent on the fixed and variable costs of their operation, as we just talked about. The high debt to equity, high risk producers who are either just getting started or for whatever reason have gotten to a point where they have a lot of money borrowed. They are highly dependent on those higher levels of coverage in order to ensure that they have enough revenue to make it through the year. So high fixed costs would include, say, a new machinery complement or high cash rents. That could be some reasons why fixed costs are high. And high variable costs could arise from low soil fertility or significant weed pressure in the past. Maybe they've rented a new farm and they aren't sure what the cultural practices were on that farm before they took a hold of it, or the excessive cultivation if they are a producer that likes to have clean fields and drives up the variable cost of their operation because they're working that ground quite a bit. These are all just examples. There's a lot of different reasons why fixed and variable costs could be high or low. So it's worth asking a lot of those questions whenever you're making this decision and kind of being honest with yourself about what kind of producer you are and what your needs will be. So in the last few slides, we talked about determining variable and fixed costs of production and understanding what type of risk a producer is at in any given year when it comes to thinking about how much it costs for them to put in that crop, how much of an insurance coverage level is it going to require for them to be able to stay in business if crop yields or prices fall and they aren't able to produce what they would expect to be an average revenue. So as we think about those things, we can move into making the crop insurance decision, which is going to look at the different products that are available to producers. And again, this is only going to be a small look. It's kind of a basic look at this. And they can take these things that they've thought about, or as they've honestly identified themselves as a producer, they can go in and have a meaningful conversation with their crop insurance agent about the products that are available and how they can use those to help out in their decision-making process. So I will ask the question here, is crop insurance simple? In the past, it may or may not have seemed simple. If you've been away from crop insurance in a while and have come back, you're liable to see any one of these terms that are on this slide. The added price options, beginning farmer and rancher, crop hail or crop fire, level by practice, enterprise by practice, so on and so forth. All these different products may or may not be available on your particular policy and can be added or cannot depending on how they will affect your yield guarantee and the price of your coverage. Because ultimately, a good crop insurance agent can help you maximize your coverage while minimizing your cost, and that would be the main goal I would drive home to producers as they try to make this decision. Is that's basically what we're trying to do, is maximize our coverage while minimizing our cost of that coverage. So these different products are available. Some may come and go, but just remember that crop insurance is ever changing, and that to keep in contact with your agent, ask questions. It's very much a two-way street on that conversation, that you, when you go into your crop insurance agent, understand that you are informed, but that there may be new things that are available that you would like to hear about. So again, test your crop insurance agents, ask them about these different products and how they can be put to use for your operation. So as we move into the crop insurance decision, I spent a lot of time talking about determining your cost of your operation. And since I work in north central Oklahoma, I tend to use a wheat budget in my examples of this. So I have a 2019 anticipated estimated wheat budget here. Again, whenever I talk to my producers about budgets, all I can say is that my budget won't match theirs. So this is here just for kind of illustration purposes. But you know, as commodity prices have increased through 2018, this is going to be a different decision for our producers when it comes to crop insurance, because we are receiving a little bit more money at lower yields. So it kind of takes some of the pressure off of this crop insurance when it comes to trying to break even and minimize our losses whenever a bad crop comes in. So we look at our revenue here at 32 bushels at $5.50 per bushel. It gives us $176. You can find that where my cursor is pointing there. So we know what our expected revenue is. Say that's the average yield for the county that we're in, and that's an expected price based on our marketing plan. If we know we have $176 worth of revenue, what does our variable cost of production look like? And again, I throw in some examples here like wheat seed, machinery and fuel, herbicide and pesticide costs, fungicides. And then again, we have our crop insurance coming up there in that list. We have labor costs, custom hire, fertilizer, harvest, and then our cash lease cost if that's our situation. I use cash lease because it's simple, but if we're sharecropping or we have owned land, we have a different land cost there. But that gives us, in my example, a total variable cost of $175 per acre. So our returns over our variable cost, not including fixed cost, is $1. So we know right away that, again, the price of wheat and our expected production is coming in right near where our variable cost of production are. So it's going to be very difficult right up front to find a crop insurance product that can cover all of our variable costs. So this is, in the greatest sense of the word, this is insurance on a part of our production. We cannot expect crop insurance to cover all of our costs, but we can surely get to a point where we're covering a majority of them to help ease the pressure if we have lower revenues than we're expecting in any given year. So as I move through my examples, I'll talk about, again, winter wheat. So in this slide, we have revenue insurance for winter wheat. And when we talk about revenue insurance, that's guaranteeing a certain amount of revenue, which we all know that revenue is a function of the price for that commodity and the bushels or pounds of that commodity that we produce. So with revenue insurance, we have to have two parts of that. We have to know what our approved yield is, and we have to know what the price that the insurance is going to insure. So we track those prices. Prices are set at different times of the year based on the typical marketing of that crop. So here, for example, with winter wheat, the projected price tracking occurs from August 15th to September 14th, which is a period of time right before most wheat gets planted in this area. So whenever that price gets set, producers will know what the projected price is and what their approved yield is, so they'll have a general idea of what the revenue guarantee is going to be on their farm. The good thing about straight revenue insurance is that we also track a harvest price. So if any time as we get closer to harvest, which is that price is tracked from June 1st to June 30th, if prices continue to increase past the projected price tracking time period, and as we get to June, if prices are higher than they were back in August, then that harvest price tracking can capture that increase in prices, and the revenue insurance will provide a revenue guarantee based on the highest price. So if prices go up towards harvest, it'll use the new higher price at harvest, or if prices go down, it will go back and use that projected price tracking from August 15th to September 14th, because that will be the higher price. So it's a win-win for producers if they have just straight revenue insurance on their winter wheat. So again, this allows a producer to lock in a revenue instead of a yield to reduce price risk. And since revenue insurance is one form of insurance, again, we will look at the other form, which is just yield protection, in a few slides. So price tracking is a vital piece of revenue protection to understand. Again, in the previous slide I went through that just a little bit, but it sets the initial guarantee and helps producers plan for the risk of expenses in the coming year. So as producers who are familiar with revenue protection will know, again, as we go into the planting period for winter wheat, we will have a general idea of what our guarantee is going to be. So you'll have your approved yield, say it's 30 bushels, and then if the projected price tracking comes in at $5, well, $5 times 30 bushels is going to be $150 worth of revenue total. And then you have to determine what your crop insurance guarantee level is. So if you're at 70%, you would take $150 times 70% to get your guarantee. So again, as we talked before, in my example budget, we had roughly $175 worth of variable costs, and we know that our insurance guarantee, the total guarantee at 100% coverage, which wouldn't be available, is $150. If we are realistic and think about our 70% level coverage, or whatever coverage we decide to choose, and we'll get into what coverage levels are available later, but if, for example, if I have $150 total guarantee at 70% coverage level, that would be $105 worth of coverage. So it's just over half of what my variable cost of production would be. If you're interested in knowing what the projected prices are at any given time, there is a useful tool on RMA's website, and you can follow that hyperlink there on your page that gives that web address. And this is an interesting tool because you can put in the year you're looking for and the type of crop you're wanting to plant. Here I have winter wheat in Oklahoma in a conventional practice, and again it says the sales closing date there is September 30th of 2018, and the year for coverage is 2019 there by my cursor. So the base contract is based off the July hard red winter wheat contract. For 2019 we have a projected price of $6.02 per bushel, and that start date begins at 8/15/2018 and it'll end at 9/14/2018. So again, this tool is available. When we get closer to harvest, this area will start to show a number and we will be able to track those prices again. So a neat little tool there to kind of track what prices are doing and kind of do some discovery there on your own as to what RMA is tracking those prices at. So we've talked about revenue protection, how it protects against decreases in price or yield. So again, you think about a decrease in revenue could come with higher yields but lower prices. It depends on which part of that equation decreases the most. So just because you have a good year, if prices fall enough, you could have a revenue loss. Well, with yield protection, we're only concerned with losses in yield. So no matter what price does, it doesn't matter. We're only concerned with what our farm produces in terms of yield. So this would be suitable for individuals, and this is just in my experience. It may be different for you, but suitable for individuals looking to lower insurance costs and those who believe prices will trend higher. If you're in a very strong bullish market and you're looking for ways to decrease your insurance costs, you may determine that yield protection is a good avenue for you to pursue. So Know that yields above the guarantee do not always guarantee that variable costs of production are covered, because again, a large decrease in price, even with an increase in yield, could end up in a situation where our variable costs of production are not covered. So it's a pretty simple product compared to revenue protection. Again, we're only concerned with decreases in yield, and it's generally cheaper, and that would be the allure to most producers. So another part of this decision that we've made, okay, we've gone through the fact that we know we need to have a crop insurance agent, we need to know what our variable cost of production are, we need to know somewhat what our fixed costs of production are, and then we also need to know what type of risk we're wanting to cover. Are we interested in revenue protection, or are we interested in yield protection only? And then that gets us to the next part of the equation. Once we've made all those decisions, we have to decide on whether or not we want optional units or enterprise units. So optional units are coverage on individual farms. So if you have a quarter section of land and you want to guarantee the yield on that land at 70%, no matter what happens to that quarter, the yield is protected at 70% coverage level. In contrast to that, we have enterprise units. Now, enterprise units are ensuring the yield of a commodity on a farm instead of an individual farm. So if you can imagine, you have several different quarter sections of land spread out across a large geographical area. You're wanting to ensure 70% of the total yield of all of those farms. So if something bad happens to a farm on the west side of your territory and the east side of your territory does really well, then you might not have a loss. Some producers don't like that. Some producers want to know that each farm is individually guaranteed, but they do pay more for that coverage. Enterprise units tend to be quite a bit cheaper, and as these graphs show, we can see what the subsidy or the government cost share portion of those coverage levels is. So with optional units at 70% coverage level, we know that the cost share or subsidy on that is 59%. So the government is paying 59% of the cost of that insurance coverage. Now in enterprise units, if we go to the 70% level, we can see that that is subsidized or cost shared at 80%. So you can see again that's a large difference in the amount of subsidy that you're getting on that particular product, because there's less risk to the insurer with enterprise units. Okay, so the person guaranteeing that revenue or guaranteeing that yield for the farmer has less risk in enterprise units because it's spread out over a larger area. There's more farms involved, and there's usually, again, a wide geographical area involved, so the chances of loss are a little bit lower compared to optional units. So it's something to think about. If you're right on the wire and you know you need guaranteed coverage on every single farm, optional units may be better for that producer. But for farms that have a good idea of what their variable costs of production are and they aren't extremely leveraged, then enterprise units can be a very good way to lessen the cost of crop insurance and to still get a guarantee on the total farm or the total revenue from a particular enterprise. Again, we're talking about just lumping all the yield of wheat together. If you have several quarter sections of land or 80s or what have you in grain sorghum, then all of those would be put together in terms of just your grain sorghum yield. So again, we're just talking about individual commodities with enterprise units and what's being thrown together. So it's something that is gaining popularity, and producers, again, can talk to their crop insurance agent about how it can be put to use for them, but it's a very good way to stay in, say, a revenue protection crop insurance policy, but to lessen the coverage by going through enterprise unit, or lessen the expense of that coverage by going through enterprise units. So again, consider that. Consider what it could do for your farm and talk to your crop insurance agent about making that decision. So I'm going to run through a couple slides now that just talk about kind of prices, some example approved yields and guarantees and prices, just to show how optional units and enterprise units can how the cost of that product changes when you go between revenue protection optional units and revenue protection enterprise units. So in this example, we can look again at that 70% crop insurance level. So we have revenue protection optional units shown here at the 70% level. We have an actual price of $5.20. So this is the price that's being guaranteed by the revenue policy. We have an approved yield of 34 in this example. Again, this is just an example, and 34 is thrown in there as an approved yield. The guarantee yield per acre is 23.8. So that would be 23.8 bushels, which is 70% of 34. The guaranteed dollars per acre, which is what we're really concerned with when we talk about revenue protection, is $123.76. So this is the number that the farmer is going to be interested in when they start thinking about their risk management plan and how much money they're getting from that crop insurance product to help cover costs if revenues do fall. The base premium for that product would be $18.76 per acre. But when we get all the way over here to the very end, $9.33 is what the farmer is actually paying when on this product after the subsidies or the cost share from the government comes into that. So keep that in mind, that $9.33 per acre for 70% coverage, because in the next slide we will talk about enterprise units. So as we advance forward, we are looking at the same revenue protection policy for the same approved yield and actual price. The only thing we have changed now is enterprise units. So revenue protection enterprise units at 70%, we still have that $5.20 level, a 34 bushel yield. So again, our guaranteed yield per acre is 23.8, and the guaranteed dollars per acre, which is really what we're focusing on, is still $123.76. So that all stays the same. The base premium per acre is $18.76, but after that increased cost share from the government, because we're going through the enterprise units instead of revenue protection optional units, we have a higher cost share coming from the government, higher percentage of what they're paying. We get that $3.75 per acre is what the farmer is going to pay, compared to the revenue protection optional units at $9.33. So again, just in this example, this shows how much lower we can push that premium and how we can decrease the cost of production just based on the type of crop insurance product that we select. So again, if any of this confused you, that's okay. Just know that enterprise units can tend to be cheaper than optional units at the same coverage level, and there's also the option of increasing your coverage level for the same price. So in this example, we can go all the way up to 80% coverage instead of that 70% coverage level and still be cheaper than 70% was in optional units. So again, have that conversation with your crop insurance agent, see if that's something that can work for you on your farm. So I'm going to run through a couple of examples in making the crop insurance decision. Again, we're getting close to the end of making this decision. So far, we've gone through finding a crop insurance agent, knowing what our variable cost of production are, determining whether or not we want revenue protection or yield protection, and also deciding whether or not we want to use optional units or enterprise units. So we're going to get into the meat of the matter here and compare a couple different years at different prices, price guarantees, and yields to kind of determine how this crop insurance coverage affects our operations. So there on the left we have 2016 revenue protection optional units. So that is as we get to this point in the presentation, and as we're a producer, this is what we're going to decide to go with. So we want revenue protection optional units. So we know that our guaranteed or our approved yield is 34 bushels. We know that the actual price for that insurance, that revenue protection insurance, is $5.20. And we're going to multiply that by 70%, which is the coverage level we chose, that 70% coverage level that we've talked about. So we get to a point where we have $123.76 worth of coverage minus $9.33, which is the cost of that insurance product. gives us a guaranteed revenue of $114.43 to cover our variable cost of production in the event that we have a loss on our farm. Now, this example was pulled for Garfield County, Oklahoma, so we have $165 per acre cost of production here after we take out the crop insurance cost. And then we're going to figure in that in 2016 there was an agricultural risk coverage payment of approximately $20 for Garfield County, Oklahoma. So that's where we start to determine how the government program decision figures into our crop insurance decision, because we know we have $20 of our variable cost of production covered based on the government program. So $165 worth of cost minus another $20 that we received from the ARC program gives us $145 that we need to cover with our crop insurance in order to assume that we have zero loss in the event that we lose yield in our revenue protection, yield or price in our revenue protection policy. So this $145 that we see here is in red because it is higher than our $114 coverage. So we know that we are a little behind our variable cost of production here, and that we're going to have a gap between $115 and $145 that's going to have to be covered out of our own pocket, whether it's a liquidity position or some other form of risk management that we're using, that the crop insurance is not covering everything that we need it to here in this example. It's just could be cost prohibitive to buy higher guarantees, or we may not, in this example, we would not be able to buy a guarantee high enough in order to cover that $145. Now in this example, using a 45 bushel CC yield or farm yield for our FSA farm number yield, we take that same $165 cost of production minus $72 from the 2016 PLC payment. Then we start getting our cost of production down below that $93. So $93 is in green because it is less than our guarantee we're receiving from crop insurance. So we can see here, depending on the government program that we were enrolled in, if we were in PLC, our crop insurance more than covers our variable cost of production after all of our government payments and crop insurance is taken out and all of that. But with ARC, we are not getting that covered. So the government program decision has a big influence on how our crop insurance is going to figure into our risk management decision. If we go forward a year to 2017, we have the same approved yield of 34 bushels, but our price has gone down to $4.59. So as you can imagine, our guarantee is going to be lower here. We also see the insurance price go down to $8.16 per acre. So we keep the same cost of production at $165, but in 2017 there's likely to be zero ARC payment in this example. So if there is no ARC payment, we still have to cover that whole $165. And if we assume that our farm is in PLC with a 45 bushel FSA yield, then we would expect $35 to come from the PLC program. So we would need to cover $130 per acre. Again, crop insurance at $101 is not going to cover the rest or the total cost of the variable production after government programs in this example. So in this situation, it doesn't matter which program you were enrolled in, you're still going to have higher variable cost of production than what our crop insurance guarantee can cover. Just something to keep in mind. This is only, again, crop insurance cannot be expected to cover all loss or remove all of the risk when it comes to production, but it is, again, in both these examples, it's covering well over half. So again, that's something that producers can look to think, well, I need to find other ways to make sure that I can operate in any given year, whether that's a strong liquidity position or something else, that they know what's in front of them. They know exactly what they're dealing with here when it comes to taking care of their risk. So in conclusion, I will just offer that low prices and low profitability offer an opportunity for good managers to excel. The crop insurance decision is one of the most important decisions a good manager will make in any given year. So think about that decision. Get in touch with your crop insurance agent. Make that a two-way conversation and try to determine what coverage level and what types of products will be best for your operation. And then we say here, be cautious with expenses that require cash outlays, because again, in those two examples, depending on the year and whenever you're watching this presentation, it may be different, but in low price years or low profitability years, it's going to be important to reduce our variable cost of production in order to ensure that crop insurance coverage can help us manage our risk. And then also remember that an average production year could still mean higher prices. So just moving forward, there's many different things that act on the market, and it's not any one thing in the world that's going to affect profitability on crops. So just think about your risk management strategy and try to make it as robust as you can in order to have a buffer between what's happening in the world and in commodity markets and on the production of your own field, and how that affects your business. So with that, that's the end of our presentation. I will offer these references here. We have a crop insurance agent locator address there. Again, we have the RMA crop insurance cost estimator listed there. There's also crop insurance decision tool and a link to RMA insurance programs. And I'd also ask you to visit our eFarm Management website to get more information on these different programs, determine if there's people that you want to get in touch with to talk about these programs more. So thank you very much for watching our presentation, and I hope that this decision isn't one that's too daunting and that we can help you work through that decision in any way we can. So thank you.